Hey, good afternoon, happy Thursday, and also happy Cinco de Mayo. We got a ton of stuff to cover here this week. We have inflation, we've got a huge focus on the Fed, which of course will be the bulk of our conversation today. And all this tees up what we're in the middle of right now in a very important jobs week. My name is Brandon Steele. I'm a financial advisor with Mainsail Financial Group here in Bellevue. And our goal every week, every Thursday, is to bring to you the market news, the data, the trends, the things that we're watching, and hopefully weed out a bit of the noise along the way. So hopefully if you're in the Pacific Northwest area, hopefully you've been able to enjoy the weather here the last few weekends. Luckily, springtime is so unpredictable, but luckily it's been nice on the weekends and then dark and gross on the weekdays. But happy Cinco de Mayo, and hopefully you can celebrate today as well. All right. Ton of stuff to cover. And I want to start with inflation, but really the bulk of our conversation is going to be on the Fed. And then I'm going to wrap up with a good question of the week on a kind of a little known strategy, but an effective one in the right circumstance called Rule 72T. So on the inflation front, we had PCE price index come out and it was up 0.9%. So obviously a very important factor into the Fed conversation we'll have here in a minute. But inflation clearly is here and it just keeps coming. I mean, it really is just relentless right now. We had nominal income up 0.5%. So if there is maybe some good news, wages are up as well. But I think a lot of that has an impact or is affected by what we're seeing in the jobs market, which I'll cover here in a minute as well. And then we've got spending up 1.1% along with all that. So inflation, income, spending, I mean, everything is up basically, right? On Tuesday, which will factor into the Fed conversation here in a minute, we had job openings come out at 11.5 million. 11.5 million job openings. I mean, it is amazing. And you may have heard the Fed Chair Powell talking about the demand for jobs and not the inability to match up supply with that. This is exactly what he was referring to, 11.5 million job openings. On Wednesday, as a bit of a teaser into jobs week, we had ADP employment numbers come out at 247,000, which is not good, by the way. But really that didn't matter because that was Wednesday before the Fed talk, and really Fed Chair Powell stole the show as he usually does. So we'll talk about that here in a minute. But gear up next week, we will break down the jobs data in a lot more detail. But today, obviously, we want to focus on the Fed. So no surprise, really. I don't think anybody was surprised with what the Fed had shared. They had been communicating a 50 basis point or a 0.5% hike for months, and that's exactly what we got. So 0.5% hike here for May. However, I think maybe I don't know about the surprise, but the thing that is maybe of relevance, or the thing that maybe wasn't as expected, is the unwinding of the balance sheet. So basically what he had suggested is that there will be two stages of this unwinding, which I think was relatively new. He had talked about this idea that we will go at a slower pace for 3 months and then ramp up after that on both the treasuries and the corporate side of it, I believe, as well. Which is, it's just really interesting to hear this projection of how exactly they're going to unwind for 4 months when we don't know what the heck's going to happen tomorrow. On top of that, he all but took a 75 basis point hike off the table. So there was a lot of conversation about June potentially seeing 75 basis points. Basically what he had said, all but said that will not be the case, and that more than likely they'll be on a 50 basis point hike path moving forward, which is also a lot higher than has typically been what he said originally was the norm. So that's important. What we saw going back to yesterday is this huge jump in the markets. We saw the markets take off when he started talking. I think we closed up like 3% or so for the day. And I think a lot of that was due to the fact that the unwinding is a slower process, as well as the fact that he took the 75 basis point hike off the table. Now, fast forward to today, we've got a 180-degree different story in the market. Markets are down huge. I mean, I think the NASDAQ was down a little over 4%. So we saw a huge turn in the markets and the sentiment from yesterday to even just yesterday afternoon to this morning. I think a big part of that is, what I thought was kind of funny to hear is how confident they are in these numbers. Like, it's very clear that the Fed missed the boat. They should have acted earlier, and I think they know that. They will not admit that, but I think that's very clear. Yet here we are, and there's all this confidence about the idea that the numbers that they have are exactly right. All this confidence in the American economy. And I'm not saying that we aren't maybe in a good place in the economy, but you would just think there might be a little bit of humility, I think. And I think that might be why we saw the downturn today, because they projected all this stuff out. But at the end of the day, there should be some, I don't know, some hedging to some degree, right? If we knew for a fact this was going to work and this is where the economy was going, sure, it would be easy to say, here's the plan, but we don't, and neither do they. And so I think maybe that's why we're seeing this pullback today, is because obviously with a raise in rates, that typically slows economies down, but also the unwillingness to say, like, here's the situation, here's what we'll do in these different circumstances, or how we can kind of accommodate for both, I guess, if that makes sense. So we'll see where this takes us moving forward. But yet again, obviously the Fed in focus, it seems to be like the entire story, as of late. So we'll keep watching that, of course. Coming up next week, as I promised, we will break down jobs data. So we have a ton of stuff to carry over there. But it also ties heavily into the Fed's decision. So we will talk a lot about the job openings we're seeing and what we're seeing on the labor market. Plus, we have CPI data coming out next week as well. Before we get into next week's session, I have a great question of the week, which is on Rule 72T. So if you haven't heard of this is a retirement planning strategy. It's a rule within the IRS code, basically, but what it allows someone to do is, generally speaking, you cannot access retirement accounts until age 59 and a half without penalties, right? What Rule 72T allows is, as long as you take out what they call equally substantial periodic payments, you may be able to access your retirement accounts earlier than age 59 and a half. Now, what this requires is that these distributions must continue for at least 5 years, or until age 59 and a half, whichever is later. And that, again, these payments are set up in a very specific fashion in order to take that money out. So what defines that equally substantial periodic payments, which is a lovely phrase to try and get out here, is there's 3 different methods to calculate that. One is the RMD method, required minimum distribution method. So for those who are 72 or older, you may be familiar with this. When the IRS, or when you reach 72 as it stands today, the IRS makes you take money out of your retirement accounts, generally speaking, and they follow a factor based on your age. So you can do that with these Rule 72T distributions as well. Second is an annuitization method. The third is an amortization method. Both basically apply your balance and an interest rate and a life expectancy, okay? Now, here's the exciting part, and the reason I wanted to touch on this. This rule has been around for a very, very long time, but what recently has come out is a new cap, or a new minimum, I should say, on the interest rate you can apply to that. So I believe it's 5% now, but it's come up quite a bit. And so for a lot of folks who were exploring this, what this new interest rate may allow is for you to take out a lot more than you might have been able to just a few months ago. Okay, so there are very specific things to watch out for when you're looking at Rule 72T strategies, because there are definitely some pitfalls you can run into. There will still be tax consequences. If you depending on how you set this up, you need to be very careful in practice, in reality, of how you actually set up those dollars. You may want to separate them, for instance, from the rest of your retirement assets. So don't take this like just on the surface as a strategy to consider. There is a lot to it. But I wanted to touch on this new update because it may allow you to take out a lot more if this strategy makes sense in the first place. So thanks for joining us. We'll see you next Thursday at 3 p.m. Have a great Cinco de Mayo. And of course, if you have any questions, let us know. We'll be happy to cover them in our weekly updates.